Well, thanks everyone for joining. My name is Scott Brovsky. I'm with UC Riverside, and I lead a program called EPIC SBDC, which is sponsoring and putting on this conference. Martin and Misty, we're all in the same team. What we focus on is basically helping startups scale. For the deep tech startups, we help bring a lot of them out of the lab environment, help them find co-founders, CEO talent, and help them get SBIR funding. And then after that, we help them with venture capital funding, as we were just chatting about a few minutes ago with the panel. So that's the basic background. And we're really excited to have this esteemed panel with us today. So what we're gonna do, just for everyone who's listening, I know it's mostly founders. I can see mostly founders are on, which is great, which is what we want. If you can just put your questions in the Q&A, we're gonna go through. I'm going to be asking the panel some questions, but then I'm also going to be basically like interrupting that flow and then asking questions as we go to make it interactive, so you don't have to wait till the end. I think it's kind of somewhat boring for people to have to wait to the end, last 10 minutes of a Zoom webinar to ask questions. So ask questions as we go. If you haven't used Zoom before, I imagine all the founders have, but you click that Q&A button down below, and then your question will pop up. And if it's a good question, I'll ask it. I'm not going to ask some of the questions that are, because I know some of the questions probably won't be so hot. So we may not answer all of them live, but in any case, let's get rolling. So Z, you want to start off with your a quick intro about your background and your VC firm?
Sure. So my name is Z, Christina Hawley, people call me Z, and I'm a venture partner with Good Growth Capital. And we're an early stage venture fund that invests in transformative science and technology. So definitely university research is core to what we focus on. Everything from health sciences to data science and materials and sustainability. In my background, for the last almost 2 decades, have been investing in undiscovered innovators at the frontier. I started 2 different innovation centers at MIT, the MIT Deshpande Center, and also at USC, where I was the vice provost for innovation for about 6-7 years. And I myself have 2 engineering degrees and mechanical engineering, and have been a serial tech entrepreneur myself too. So our fund is very much operators through and through. Our 5 managing partners have created 18 startups that are worth billions in capital, and really know how to roll up our sleeves. And so, we love university startups.
That's great. Thanks. Ari, you want to go next?
Sure. Thanks for having us. Appreciate it. My name is Ari Littman. I'm a general partner at Mars Bio. Mars Bio is a pre-seed and seed stage venture fund based in Los Angeles, focused on biotech and life sciences startups, from health applications all the way to food, agriculture, materials, and industrial applications. And similar to Z, we like to invest in companies very early, fresh university spinouts, a couple of entrepreneurs in their garage, happy to come in at the earliest phases and provide support to those entrepreneurs. Focused on LA and Southern California. We think there's a lot of hidden talent here, and we're really excited about kind of how the ecosystem is developing. My history is, I'm originally a molecular biologist by training, started a company in the molecular diagnostic space, wrote a number of grants through that process, so I have some familiarity with the SBIR world, and eventually made my way to kind of being a startup operator and investor over the course of the last few years.
All right, great. YP?
Hi, my name is Yi Pan, a partner at Embark Ventures. We are based in Santa Monica. We are an early stage venture firm investing in deep tech startups. 80% of our deals are funded by scientists, engineers from the different universities. So we try to back smart scientists, engineers, commercialize their R&Ds and research. We do very early stage as well, so anything from pre-seed to seed. But we also do sort of later stage Series A as well. So and we also incubating deals out of universities with different professors and PIs groups as well. So I'll say full spectrum type of venture firm. In terms of my background, I was actually a scientist. I dropped off my PhD program a couple of years ago, and since then switched to investment world and working for a private investment firm for about 5 years, and then founded Embark Ventures with my partner about 3 years ago. We're still investing out of our first fund right now. So
That's great. And are you also, are you looking nationally, globally? Are you focused?
Yeah, I would say nationally in the United States. I would say
okay.
the core sector, the core locations we focus on is Southern California and Boston. So it's the two locations we spend time on.
Okay, great. And then Z, I think you also have a pretty strong presence on the East Coast. Is that correct?
Yeah, we're actually headquartered in the East Coast in South Carolina, which is unique, but we were, for I think the third year in a row, named the most active investor in South Carolina. But we do a lot of deals around, like the whole up and down the coast, and Boston. We do a lot of, in fact, we have a fund that focuses on transformative science, pre-seed, seed, with a heavy focus on MIT startups. We have an office in Boston, and I'm basically the first venture partner in the Southwest. And so I just led a deal in that came out of UC San Diego, but is now in Indiana. Have done a deal in the Bay Area, another one in Boston. So we really do look, and we do a lot virtually as well.
That's great. We need to get you to do a deal here in Riverside or in inland Southern California next.
We're looking at one. So
yeah, exactly. I think hopefully we'll have something good for you. So, so you know, one thing that we find, you know, a lot of the deep tech startups that we work with, you know, they'll hear talks or advice from investors, whether it's, you know, but typically they hear a lot of advice from investors who are investing in software startups and B2B SaaS startups. And they often get mixed, I think, and incorrect information about the kind of traction that investors are looking for. So if we could maybe just have each of you describe a little bit about what kind of traction you're looking for from the deep tech investments that you make in the various different verticals. I don't know, just whoever wants to start can jump in, and then we can kind of go through the group.
Yeah, I can jump in. Or
oh, no,
yeah,
you can go.
Okay, thanks, Yipeng. Yeah, I'll start, I guess. I mean, I think as pre-seed and seed investors, a lot of times these startups won't have a lot of customer traction, that's for sure, especially if you're talking about something in the therapeutic space that's going to take years and years of clinical trials to get to market. So I think you do have to kind of reframe the question about what traction means in this space. And for me, the story always starts with the science. And that's kind of where I begin my journey of understanding what a startup is trying to do. And from there, begin to extrapolate to the markets that science could apply to, and whether or not the founders, I have confidence that they can execute in those markets. So that's kind of my take on it. You know, you don't have to have a huge customer list necessarily on day one, but having a clear path to market and the clear understanding what it takes to get there, I think, is key.
Great.
Yeah, so I think, you know, my thought is because we don't do a lot of therapeutics, so my thought is really on things outside of therapeutics. So I think therapeutics is a different, you know, beast, right? So there's different tractions you need to prove for therapeutics, but for general tech companies, deep tech, I would say for seed and pre-seed, we don't need to see a lot of commercial tractions, but we do need to see, I guess, the maturity of the technology and the science, right? So, you know, as a venture firm, we are not a, you know, government agency, so we need to make sure there's no, or there's very little science risk, right? There could be engineering risk, there could be R&D risk, but we don't want to have scientific risk at some level, right? So no biology risk, no other science risk. In terms of the company going to Series A, I would have to say the Series A is actually the toughest for deep tech companies, just because other investors, later stage investors investing in Series A and Series B, they actually treated the deep tech company almost as the same as B2B SaaS. That's just a fact, almost a fact. I would say you almost have to, you know, have decent amount of tractions in order to raise a very good Series A round. You know, obviously you can raise the Series A round without a lot of the tractions, but in order to raise a very good Series A round, you have to have a decent amount of tractions, meaning, you know, product market fit, business models, you know, potential revenue stream, and all that other stuff, right? So I would say once you go past this stage, the tractions you need to have is almost the same as the tech companies. You know, maybe a little bit less just because the development cycle is relatively long for deep tech, but I would say you have to aim for the similar level of milestones you have to make. So
that's a great point. I don't think a lot of people talk about that enough, about the difference in going from seed to Series A with deep tech. So that's awesome. Thanks. Z?
Yeah, I would say that we don't just invest in technologies. We are hoping that for traction at a minimum, we would want to know that the team really understands the space and the industry that they're going into. So, having conversations and really understanding what are the incentive structures, what are the pain points, what's the go-to-market strategy. And, we will, if I had to pick one or the other, like, do we make quick decisions or deliberate decisions? We're a bit more deliberate because some of these things you just don't know. And you won't know for a while, but what you can do is we'll have conversations both with the companies that the startup has had conversations with, and then our network and folks that we know from the industry as well. So we just want to know that you have a unique perspective on the problem and a solution that's solving an actual problem. You don't have to, the earliest stages don't have to necessarily have customers, although, that's nice.
Yeah, definitely.
I want to add one thing to
go ahead.
echo on this point is I would say later on when we're talking about Series A and Bs, I think one of the key thing and one of the hardest thing for deep tech companies to have a KPI to show to investors, right? So unlike SaaS or B2B SaaS or general tech, we don't have, a lot of companies doesn't have ARR, doesn't have a churn rate, right? The traditional metrics for venture business just doesn't really apply to a lot of deep tech companies, right? I would say after your pre-seed or seed, really thinking more about what type of metrics you need to show to the investors later stage. It's actually a good practice almost, right? So you're gonna run into a problem where you can't really have any traditional metrics to show to investors later on, right? So yeah, that's just to echo on these points. Okay,
great. Also, we had about, looks like 40 or so people join a little late. So for those of you that join, we're doing Q&A during this session, so you don't have to wait till the end. So if there's a Q&A button below. For those of you that don't know Zoom, click that and ask your question. I see we have one from Karen, which we're going to answer in just a second. Before we get to that though, one thing another question I wanted to ask is, so because we're working with a lot of first-time founders, we're working with a lot of stuff that's coming out that we hope to bring out of the labs, or just our region, especially inland Southern California, has a lot of first-time founders. We don't have the same, depth of, entrepreneurship, I guess, DNA that is on the coasts generally. So I guess the question would be like, for each of you, what would advice be for the first-time founder who's either bringing their technology out of the lab, or they might be a community-based company that also has a deep tech solution that they're working to scale and commercialize? So any advice for first-time founders?
One thing I would say is that it is, I think it's perfectly fine for your team not to have the experienced CEO on board, especially when we're talking pre-seed seed, right? So, but what I want to see is that you have the humility to know that you aren't necessarily the experienced CEO. And so you're willing to either learn what you need to do to take on that role, or more likely to be willing to step aside for the right CEO at the right time. It's also important, if you are an academic, if you're a professor, for example, I think the best model tends to be that maybe a postdoc ends up leaving and then being the main founder, and then maybe you as the professor would maybe take a leave of absence, et cetera, but not taking a key executive role. And it's sometimes hard, I find, for academics to put aside the ego. And I would just urge you to think about how much more influence you have when you're back at the university cranking out more startups. Do what you do best, be the academic, maybe take some time off, help spin something else out, work on the next one. My favorite role model for that is Bob Langer at MIT. He was on my board when I was at MIT, and he's just incredible. He's just done dozens and dozens of startups because he really doesn't feel like he needs to be hands-on in all of his startups.
Great advice. Ari?
Yeah, I mean, I think one challenge specifically around spinning out academic IP and starting university spin-out companies is that we as scientists are just natural skeptics. And, we have a tendency to think of all the ways things can go wrong, in addition to the very few ways things can go right. And that makes making that leap to start a company particularly challenging, I think, oftentimes for scientists. So I think it's really important to come at problems with a bit of a beginner's mind, and to some degree forget all the things that you know in a lot of ways. Now, I'm not saying you need to be overly optimistic, but I think the startup founders that tend to be most successful are able to build a team around them that has a good balance of just super deep technical knowledge, but also optimism about what could be created in kind of a best case scenario. So I definitely encourage kind of folks who have tons of academic training to try to really, dream, think creatively, assemble a team that can allow them to do that in order to sort of move to the next phase.
Okay, cool. Yipeng?
Yeah, I would say my number one suggestion will be spend more time talking with peers, because I think oftentimes university spin out, you just don't have the Silicon Valley vibe, right? You don't have a lot of peers to talk to, right? So I think that's the challenge of ecosystem like Los Angeles or England, right? We don't have a lot of entrepreneurs to talk to, right? So especially for professors or PIs or postdocs, right? So I would say number one thing would be talking to as many people as you can, both from customer interviews, to determine whether this is actually truly a good company or not, but also just to talk to your peers for co-founders, for any other potential hires, right? So I would say spend more time networking with your peers and networking with the community. I think it's very essential, right? And I would say my second advice will be really think hard whether you want to start a company or not, right? Because oftentimes startup doesn't work out, right? I mean, in fact, 99%, they don't work out, right? So you have to basically think harder, right? So oftentimes I see a professor start a company and they, in middle of the way, they find it's too hard and it's too many work, right? They just give up because it's too much work, right? So, and often, I mean, that's not a good sign, right? So, we really truly have to think if this is something you want to do for the longer term, right? So, a startup won't be able to success in, less than 10 years, right? So you have to make sure this is a longer time commitment, right? Whether it's you or your postdocs or whoever, right? So, yeah.
That's great. So let's work a couple questions. Oh, go ahead, Z.
I just want to add two things. One is just to tag onto what Yipeng said, and also what I was mentioning earlier is like you're not an expert business person, and that's fine. But what you really do need to know, there isn't one like perfect business expert out there, right? It's more really, really important that you understand your industry. And so you could then work with folks who understand business to coach you. But that's the most important thing, is that's the unique perspective you're bringing. The other thing that's related is that don't think that just because somebody has business, in their experience, that they're the right CEO. I have coached faculty who brought on, for example, it was a biotech company, and the professor had met a real estate guy at a tailgate party and thought, oh, he's a donor to USC, been successful, like he's going to be a good CEO. There's a big difference between a business person in real estate and someone who's in biotech. You're better off just working on it until you get the right person.
Yeah, totally agree. Yeah, spend more time interviewing more people, right? Spend more time networking with your peers and find the perfect fit versus, make decision early and be regret later on, right? So.
Definitely. So let's work a couple of questions in, and I actually will answer this for Kieran, but I'll let Z answer it as well. But so Kieran asks, Z, can we reach out to you for advice, not necessarily pitching? So before Z answers, let me just say one thing about that. One thing we try to do with the startups that we mentor is we try to help the startups get ready to talk to investors and make sure they are ready to talk to investors. And one of the key things is, please research the investor. Please research the VC. I can't tell you how many VCs we hear from who get cold calls and cold emails from people who are completely out of the verticals that they're interested in investing in. So I'll let Z answer the question, but from Kieran. But anyway, I just wanted to throw that out there because that's something that wastes a lot of time and not really necessary. So please do your homework and research the investor, and also not just the VC, not just the fund itself, but also the partner. So for example, like we send different deals to Yipeng than we do to Peter. We send different, so you really got to know what you're doing, if you expect to get connection with the investor. So sorry for that answer, but I just wanted to throw that out there. Go ahead, Z. Are people able to reach out to you outside of pitching?
Thanks for your running interference there. So I would say that venture capitalists are incredibly busy. They get pitched all the time. I mean, we look at thousands and thousands of deals a year. And so I have to ask for forgiveness in advance if I try to be responsive to every email as much as possible. That said, that I will give some advice just generally when you're trying to look for advice, is thinking about who you can talk to that might give you some good perspective, that also would find that they're learning something from you too. Because like offering up a coffee, of course, it's a pandemic, it's a little different, but like offering up a coffee, it's like, I don't need someone to buy me a coffee, but you know, if you have a perspective on, you know, some aspect of the space industry or in new materials or something that's super interesting and super new that I don't know about, then I would be interested in having a 15-minute conversation with you just to learn about that kind of technology. One thing I would also suggest is be really cautious about how much you, we don't want to disappoint you, right? So I was at an event once, and somebody actually in front of other people asked me like, would you be my mentor? And it put me in a really awkward position because like, well, mentor, I don't take to, you know, like it's one of those things that it develops over a very long time, but it also made me feel badly because then it puts me on the spot because I don't want to disappoint anybody. So just put yourself in our shoes as well, where we want to help. And most importantly, like we like to learn. So that's probably the best way for you to get a little bit of like 20 minutes, 15, 20 minutes of somebody's time.
Do anyone else want to add to that about people contacting you about non-pitch related stuff? I think it's probably the same answer, but if you guys want to, or if you guys want to add.
I'll add a little bit to that. It's a great point, Z. And I think the point about interacting with somebody pre-pitch or just to learn about a new sector is really important. The thing that I'll say is that in a great scenario is that you've built a relationship with a VC over the course of a number of months or even years before you're pitching them to raise money for your startup. That's a great position to be in. If you have some really great technical strength, you're working on a new project in a lab and it's something that the VC is interested in. Some of the best deals I've done have been people that I've known for a year and had a number of interactions, getting to know their ideas as they develop and as they think about starting a company. So that's a wonderful scenario to be in, and where you're not kind of just having a one and done type pitch session. So I would say absolutely, if you find someone where that's a fit, where it's a sort of a mutual interest to begin that dialogue, that's a great place to be.
I would want to add, I think, you know, it's good to have a conversation before you start raising money. So, you know, talk to VCs before you start raising. But I would say the connection has to be organic. Then, you know, if you don't want to reach out to VC if you're not raising, because that's just honestly a waste of time to you, right? You don't want to talk to a VC before you start raising. So I think most VC will not take it seriously if you're not raising. It's really, you know, I think that's just the truth, right? Maybe some people will say, you know, I want to be helpful regardless, but in real life, if you're not racing, just don't talk to VC, because that's just a waste of time, in my opinion. Like I talk to all our portfolio company. If you're not racing, just don't talk to VCs, right? I mean, have the organic connections, but don't reach out to VCs, right? So if you happen to know a VC before, or you know, if there's organic connections you made or whatever a couple years ago, that's cool. But do not waste your time talking to a VC if you're not racing. And most of the time, the VC will not give you good advice if they are not even a stakeholder of the company, right? And not saying that's 100% the case, but because we don't even know your company that well, right? We just maybe just had a one conversation with you, right? There's no way I can give good advice anyway, right? So, you know, I'm not going to pretend I can give good advice with like only one pitch, right? So, you know, I think it's yeah.
Yeah, I think that's a great point. Yeah, definitely. So we kind of we touched on this a bit earlier, but Sophia is asking, maybe if anyone wants to add anything to it. If not, we did kind of already cover it, but Sophia's asking, what key metrics do you look for at the pre-seed seed stage?
Yeah, I would say,
I know it's hard without knowing the vertical, but I mean, let's just, I mean, any kind of, if you want to pick a vertical that you guys invest in and right, use that as an example, that's cool.
Yeah, I would say pre-seed and seed are two very different stages at some level, right? So I think for pre-seed, what we're looking at is absolutely the best scientist team. You know, I think we look at the top one or top two in the field. That's the only time we will do a pre-seed deal. We have to make sure the science team is the best, right? Or one of the best in the world, right? So that's why we are actually very, selectively doing pre-seed deals, given, if it's actually funded by smart scientists or top tier scientists. So I'll say the people is the number one for pre-seed deals. So we have to make sure the team is, especially the science team, it has to be rock solid, right? So that's for pre-seed. But I would say for seed, for us at our firm, I think we have different metrics. I would say we look at doing customer cost, diligence costs on customers, right? For example, early tractions, maybe LOIs with customer. That's one of the good metrics we can have, right? So early revenues, it doesn't, maybe you're deep, for example, for material companies, you might have early revenues already at seed stage, right? So very early revenue, maybe pilot revenue, maybe, I don't know, some other revenues, right? So early revenues. Team building is also a good thing to see in terms of metrics. Basically, I think Mark Suster has a good thing about, basically investing in lines, not dots. I guess we want to see your trend, right? See how you build a team from pre-seed to seed. I think that's a good metrics for us. We want to track the company from pre-seed to seed and see how they build up the team, right? So I think that's one of the most important metrics for us to invest in seed is to see how many people you hired, what are the people you hired, right? So what are the advisors you bring in and all that stuff. So I can get into many details, but there's many other metrics we're looking at, but that's kind of some of them. So.
Okay, great, thanks. Anyone else want to add before we go to the next question?
One of the most important things I tend to find myself asking when somebody's pitching is what are the milestones you're trying to hit with the round? So I think that having a really good understanding of what it's going to take to raise the next round, and then what you see for the pre-seed or seed can vary by the company. But I think that's really important, is to know, like, what are you going to need in order to raise the next round, and tell me that, and make sure that you're not undershooting with the amount of money that you're raising. Like, sometimes we'll tell the team, we'll say, we don't think that you're putting aside enough for patenting, or I think you need to hire a few more people if you're trying to hit those, sales numbers. And that's the important, I think, conversation to have.
Yeah, actually, that was one of the questions that I was going to get into later, but I guess we can talk about it now as well. I mean, we, as I said, we mentor many startups, and one of the things that most of especially the first-time founders struggle with is they almost never have milestone-based financing figured out or in their pitch deck. And so we really hammer on that. Like, you need to know, you can't just say I'm raising a 750K angel round and and here's my lame chart that says I'm going to put 20% into marketing and da-da-da. But like, milestone-based financing, what are you actually going to do for those dollars? And I think that at least most of the angel groups and angels, and as well as the early stage VCs we work with, they want to see milestone-based financing as part of the pitch. So I don't know if everyone agrees with that, or I guess it depends also on what stage. Maybe if you're super early, it might be too early for that. But I think generally at the seed stage, most investors want to see that. Would you all agree with that? Milestone-based financing?
Well, one question here is, I don't understand, like, milestone-based financing typically means you fund the company by different stage, right? Like, are you saying that, or
what I'm saying is it's like a milestone-based use of funds. So for example, for the $1 million, we're going to get to this gate. And, for the first 200K, we'll get to this gate. And then, for the next, So I just think most of the founders we see, especially coming out of university, don't have that in their decks. They've not built a strong pro forma or forward-looking financials. I just didn't know if this group feels like that's important. If not, then we should tell the founders.
Yeah. It's definitely important thing, but I would say, I want to, just to emphasize on, I think you agree on this point. I think it's not only the financials, but also the other milestone you have to make in order to raise a good round, right? Because that's not only the financial, but also R&D development, right? Other stuff like, compliance, right? There's a lot of different style milestones, right? So I feel like a financial milestone in terms of budgeting, that's one thing, but there's also other milestones you have to show to investors.
That's a great point. Definitely.
Yeah.
Something related to that, I think, to preserve equity. So, there's advice out there that says you should raise way more than you need. There's a few reasons why that's not such a great idea. Sometimes you get this Taj Mahal syndrome, and then you end up overspending. And it's good to be hungry. But the other reason is because you want to preserve your capital. You actually, if you look at how it works, you end up preserving more, creating more value at each stage, and then you can raise a better terms in the next time around. What the downside is that you end up spending more time raising money, but the upside is that you truly can, especially when you have so much to offer, you really have an opportunity to build your equity and also be able to pivot much more easily.
Okay, great. Well, the questions are stacking up, so I'll start getting to some of the questions and stop asking my questions. So Ed wants to know, are any of the panelists familiar with NCE2 technology transfer program?
I'm not.
I know the person who, yeah, I know the person who started it, but I don't even know if he's still there, so I really don't know much about it.
Okay, I don't either. But so Ed has another question, so we'll move on to Ed's next question. So Ed asked, do any of the panelist firms require equity stakes for pre-seed or early stage startup ventures? I guess maybe he's asking whether or not you do convertible notes or priced rounds, or maybe I'm not exactly sure what that question is, but I would assume that you all do convertible notes for early rounds, or is that not the case?
We do convertible notes or safe, but we prefer priced. So I'll say 90% of the deals we've done are priced round. We like to price around, or at least participate price round, because we have ownership targets for pre-seed and seed. So we like to have certain ownership targets. Depend on the stage, so we like to price it.
Okay. Anyone else want to add to that?
We typically do safe notes or convertibles.
Okay.
Yeah,
So
I would say
safe notes.
we're flexible, but we definitely do quite a bit of price rounds. Same.
Okay, cool. Milan asks, what is paramount to a fundable startup, the technology or the team, and what are their relative weights? That's a good question.
That's a great question. I'll chime in really quick on that. Just kind of framing it in, I guess, pretty general terms. So there's a lot of great technology out there. There's a lot of great IP out there. But for us, usually the people are the limiting reactant. You obviously have to have both, but I think it's kind of a bit of a fallacy to some degree that comes out of academia, thinking that the technology is the key, that's the diamond in the rough, but it's really about the people to execute on that technology for me. So now you have to have both have a successful startup, of course, but it's oftentimes the people that are a bit rarer to find who can actually execute on building that company.
Yep.
Couldn't have said it better than myself.
All right. So next question from Matt. Hey, Matt. For early stage deep tech, how do you like market size presented in first pitch? TAM, SAM, SOM, founder calculations versus citing market research pubs, any things to avoid? It's a great question too. Anyone want to take that?
Yeah. I mean, for us, we always do market research ourselves, right? So that's actually one of the biggest things we do in diligence for early stage. So you want to bet on the good track, right? You want to bet on a good market versus a shrinking market, right? You want to make sure the market is growing, right? So, for us, we always like to do a lot of diligence on market, but we don't necessarily trust founders' slides. So you can put any numbers in your slide, right? Like honestly, you can put a $1 trillion market size, right? So it doesn't really matter too much. So, and also I think for us, it's not the absolute size that matters. It's really the growth, right? It's the trajectory of the market, right? Because oftentimes when we talk about deep tech, it's a new market we're entering, or we're actually creating a new market, right? So, for example, we have one company that are doing a new membranes, a new material for filtration, for example, right? So, that company is trying to create a new market out of the blue, basically, right? So, in that sense, we can't really trust the existing research because, they will tell us the market is zero, right? So, which is true. So right. I think you want to show the investor the market you choose to, have your product in has a good potential to become a $1 billion market versus the SAM, TAM, or SOM, or some of the other terminology you can use. So that was just my opinion here.
All right, cool. Yeah, that's a great point. Anyone else want to add to that?
Yeah, I mean, I think it just, I agree that we don't trust, just at face value, but what you don't want to do is go, it's worth millions of dollars. Sometimes, people actually think that's impressive. You just, it's got to be in the billions, you know what I mean? Like you got to, yeah. And so I actually do like to see just the thought process of understanding what's the full potential, like, and how, I do agree the growth is really important. But also, like, how are you segmenting it, and who is going to be your first target market, and how well do you understand it? The top down, not that interesting, just because Gartner says something, because in theory, you're doing something that nobody's done before. And so you won't find market research on the thing that you're creating, really. But understanding, like, what are you supplanting? What are you taking the place of? And understanding from the bottom up, what is their process? Like, what is it? What are their drivers? What does the ecosystem look like? And in some cases, sometimes the person making the decision isn't the one with the money. In medicine, that's very common. Also in ag tech, that could be an issue too. So really, I want to see that you really understand what are the financial drivers of all the players who are making the decisions.
That's great.
The only thing I'll add is that for us, if we're at the stage of a pitch, we probably already have some conviction about your market. So that's not the most important thing to convince us of. If we're even bothering to pursue that discussion, we're probably already convinced that this is an area we want to invest in broadly.
Okay, great. So Kevin, hey Kevin, Kevin asks, how do we know if an investor or VC is actually interested in investing in a particular sector? Well, I think, I'll let you guys, I keep wanting to answer some of these, but I'll let you guys answer. So anyone want to take that one?
Well, it's very hard to know.
Yeah, I mean, I was going to say, just look, a place to start is looking at the current portfolio, assuming it's public. That gives you a good sense of the sort of prior art. So, that should narrow it down a little bit, and it may or may not be explicit on the website that they only invest in X, Y, and Z.
Because I think the challenge of VC industry is every VC is a little bit flexible at some level in terms of decision making. So it depends on the partnership and their IC committee. Most VCs are relatively flexible. They could do one-off deals, right? If they really like the founders, right, or something like that, right? So I would say overall, it's very hard to know exactly if the sectors they are actively investing. But I would say one thing to know is if you know some of their portfolio company CEOs or portfolio company founders, you can actually ask your portfolio founders about their overall strategy for next year's investing pipeline. Because oftentimes on their board meeting, they can discuss with their entrepreneurs, right, their CEOs. So, and they'll probably have some information leaked outside on sectors they are spending time on. Right? So.
And another thing, is shameless plug, you can also, sometimes you can ask a mentor group or a team of mentors, because I track, I don't know how many investors, 60, 70 investors, and talk to them regularly to see, like you said, if they're no longer excited about this vertical and they're more excited about that vertical, or if they already, and the other thing I would say is, also look at if the investor has already invested in your vertical or in something that's very similar to what you're doing, that may not be the right investor to talk to, because there's also conflict issues that can come up for investors. They may not be able to invest in a similar thing to what you're doing. So I think, like everyone said, just doing your homework as best you can, using Crunchbase, other tools, obviously going to the website if the VC has a website. Many VCs are on Twitter and they're active on Twitter. You can get a lot of information about what VCs are interested in by going to Twitter and searching for them and finding them and seeing what they're talking about. So those are just a couple other things I would recommend. Lynn asks, I have a VC meeting coming up. How do I best prepare for it, and what questions should I be prepared to answer that will give info but not give too much away? Well, actually, I wouldn't even think at all about giving too much away. You want to give it all away in a VC meeting, because otherwise you may not get a second meeting. So give it all away. And also one quick thing that we see a lot with our first time founders is asking investors to sign an NDA. Please don't do that. It's an amateur hour move, and it just makes you look like you know what you're doing. So I'll let the panel ask on what a founder should prepare for an upcoming VC pitch or meeting, just in general. Anybody?
Yeah, I would say the people saying is the first meeting, the main goal should be get a second meeting, right? So that's your goal, right? So get a second meeting. So basically, you don't want to lose the momentum. First you want to give out everything, so you don't want to hide any information, but you just want to make it as impressive as possible to get a second meeting, because that's a real battle start, right? The first meeting is really the general impression, right? So I'll say be natural, act natural, don't lose momentum, yeah.
Ari, you were gonna say something?
Yeah, I was just going to say, I mean, just 2 quick points. If there's lots of great sort of startup pitch templates out there in terms of the framework and format and what information you should include, team, IP strategy, go to market, blah, blah, blah. If you follow some of that guidance, that will pretty much cover the information that you need to cover. Y Combinator has a bunch of free resources available to that end. And then the other point, just briefly, is that kind of tail end comment of not giving away too much kind of comes back to that question of what's the limiting reactant? Is it the technology or is it the people? It's usually the people. So it's no VC is going to steal your idea because they don't have anyone to execute on it. You need to convince them that you're the best person to execute on it.
Yeah,
Good point.
I'll agree with that. And I also think keep the pitch short, really short, because and get it to them in advance. Assume they didn't see it, but that said, there's going to be a lot of questions. I think that the biggest mistake that entrepreneurs make during the pitch is to think that it's a pitch and it's actually an opportunity to listen. So, spend 15% of your brain cells pitching and the other 85% of your pitch listening for the questions they're asking, because the questions are going to indicate what are you not conveying that you should be conveying, and also like what does this particular firm care about? How is it going? Like, what are some of the things that you really need to work on? And a corollary to that is when they ask a question, you may not know the answer right away, and that's okay. The worst thing to do is to spend all your time trying to defend yourself. It's perfectly fine to say, that's a good question, let me get back to you. Or say that's great advice. You know what I mean? Like, don't try to spend your whole time defending yourself.
That's great. That's great advice. Michael, hi, Michael, asks, what is your experience to investing in post SBIR phase 2 projects? That's a great question too. Anyone want to start with that one?
We've only done one deal that finished SBIR phase 2. Most of the company we invested in either doing phase 1 or apply for phase 1, got it after we invested, or just finished phase 1. So we only have one company finish the phase 2. It was a pretty good company, I would say. So my experience being really good. I think SBIR helped them a lot in terms of the development. That company was, pretty, I would say, they raised a little bit venture funding, and then, basically have a lot of SBIR funding since then before we funded them. So I would say the experience is really good. So that's all I can say.
It's great. I mean, having non-dilutive funding like that can help you really increase the value of your company. And just the fact that it doesn't matter really where the money came from, but it's like that, whether it's SBIR or some other non-dilutive funding source. But one thing I would caution about SBIR funding is every once in a while, these companies will there's this perception that some companies who have SBIR funds become these grant mills. And so they're always like running towards the next grant. So the main thing you need to do is whenever you apply for SBIR funding is it core to your business? And often it can be really good support to not only pre-funding, venture funding, but also in parallel. It can help you kind of expand what you're doing a little bit, but never lose the focus of your company and never get into the business of just going for the grants, because you don't get leverage off of that. It's a great way to get off the ground, but be super careful how you use them.
Yeah, that's a great point. I have to say, we see that a lot where, especially if startups are coming out of the lab and they have an SBIR, and if fundraising is going slowly or not going well, they'll say, well, we can always just apply for another SBIR grant. It's not that we don't need to worry that much. It's like, I think that's a great advice from Z, not to become an SBIR mill startup. That's definitely not. It doesn't look good to investors either.
Your goal is to get escape velocity, and
exactly.
Then you don't want like too much fuel. It's not going to let you get off the ground.
Exactly.
The wrong kind of fuel.
Anyone else want to add to that, or should we go to the next question? All right, next question. Ed asks, although the webinar topic is leveraging SBIR, non-SBIR awardees are also considered equally, assuming all the metrics. And because basically I think what Ed's asking is if they don't have an SBIR, yeah, this is meant to be just a general deep tech fundraising question Q&A. So I guess the question is from Ed's wondering, are you going to look at a startup that has received SBIR funding and rank them or rate them higher than a startup that's coming out with doesn't have that support, I guess?
No, not for
You
us.
look at where you've gotten. If you have an SBIR, you've probably gotten further along, and that's a good thing.
Yeah. So yeah, there's no. I think that's for the founder community, especially in deep tech. I think that is a little bit confusing. I know we've talked to some founders who say, "Oh well, I'm not even going to apply to an SBIR because I'm not a professor, or I don't have, I'm not connected to a major university, research university." And so I think, and hopefully this conference and the great job Martin and Misty have done, and with all the different program managers have cleared that up a bit, that you don't necessarily have to obviously be a professor or connected to a university to apply for an SBIR. So I hope that answered your question, Ed. If not, you can put a follow-up down below. We'll try to get to it. Brian, hey, Brian from our team at UCR asks, I don't believe the panelists have funded a UCRIP licensed startup yet. And I think we talked about that a little bit earlier before everybody got on. But what type of university licensing terms do you see that are most challenging for VC investors? That's a great question. We do have quite a few VCs, not necessarily with the deals we're showing, but there's definitely some investor complaining about licensing terms sometimes. So can you all each touch on that? Because that's a big one.
Yeah, I can start a little bit. I mean, I think obviously I'm not an IP attorney or tech transfer licensing, guru or anything. I'm just I haven't taken any courses in IP licensing before, but based on my, on my experience, I would say most universities for startups are pretty friendly terms. I would say typical royalty and then maybe a little bit equity deals. And most of them would defer the royalty until later stage financing. I would say most universities are pretty friendly in terms of startups. I would say the challenging deals I would say are, number one, IPs with multiple universities and multiple research labs. Like we are negotiating one deal right now with Northwestern and the University of Texas. So, IPs involve two labs at two different universities are typically very hard and very complicated. One university has to take the lead and be the lead, attorney and whatever, and do the negotiation. So that's typically very complicated, and we don't like it. I would say another challenging part is where during the negotiation, some of our portfolio company actually want to ditch the IP and give up the IP to the university, because along the way we actually found out the IP is not useful anymore for the startup, and that could create a lot of frictions with university transfer office, just because they have the thought about already licenses out this IP, and during the negotiation we have to drop the IP, right? So we had a couple portfolio company are going through that process in terms of dropping the IP during negotiation. Which is never an easy conversation, but sometimes you have to do it. So.
Oh, we lost your audio for a second. Okay.
Oh, okay. Yeah, sorry.
Or maybe it's just me. It could be my audio.
It was you.
It was
we got
me.
it.
Okay, good. Sorry. Hopefully my internet doesn't go down in the middle of this. So Ari, do you want to chime in on that, and then Z?
Sure. Yeah. I mean, I think one of the big challenges with this is that there's so many kind of cultural differences between different universities, whether it's private or public. So for us, I think the main pain point or complaint is related to how long these processes can take and how opaque the process can be in terms of negotiating a licensing agreement. So that's, I think, the biggest frustration we have is that, from university to university, the negotiation process can take a couple weeks. It can take months and months and months. So I guess, I dream of a day where there's more standardization across different universities. I dream of the day where there's something like a safe note for licensing agreements. That would just be amazing if there became some standard document. So we've talked a lot and talked to lawyers about it who told us we're crazy, but I'm just going to throw it out there. If someone can think of it, we would love to see that in the future.
I think there is, but anyway, we're pretty lucky. I think a lot of times the faculty have already negotiated the agreement a lot of times, but we also would love to help as well when appropriate. I used to oversee the tech transfer office at USC, and we have Lita Nelson as one of our advisors. She's a very, very well-known, like the top, tech transfer person, used to be, at MIT. And so those kinds of IP things, we can certainly help in the process. And I think part of it is just giving the university the sense that you respect them. This sounds really weird. It's not just the terms, but it's a really hard job. I could tell you from the other side, because you have to make everyone happy, the university, the faculty, the startup, the venture capitalist. You're stuck with all these different stakeholders, and and everyone is blaming you for things going really slowly. And usually it's not that person's fault. It's someone else in the loop, and they're all just blaming the tech transfer person. So just be really nice to the tech transfer person is all I'm saying.
Well, I know Brian and his team will be glad to hear you say that.
Yeah, he's cheering.
Yeah, Brian's definitely cheering, and all the other tech transfer folks as well. Which is, yeah, their job's tough, and they're trying to help. They're trying to obviously, help the founders, the professors, whoever it is, whose startup it is. And do give your tech transfer office a break, because they're doing the best.
But I do think it's challenging. So the one thing is, it has to be, do it quickly, and also just be business friendly, and just realize that there's a very big difference between licensing to a big company, which has a lot of capital,
right.
Can pay you royalties right off the bat, can take over all the patent costs, et cetera, versus a startup. Just because they've raised a couple $1 million does not mean that they have money to burn on, tons of patent costs, et cetera. So just, deferred costs, some combination of equity royalty, that's really usually a nice thing.
Okay, great answers. Sophia asks, why are pre-seed rounds priced? And I don't know that many.
I don't think they usually are.
Yeah, I don't think many are. Maybe we.
Yeah,
when we talked earlier.
I would say we actually like to price pre-seed round, to be honest, right? This is a little bit uncommon among the venture community, but we actually price this amount of pre-seed rounds.
You do.
Even for seed node, we actually put cap on it, for example. But we actually like to price it for a couple of reasons. I think number one, if you do a safe node with a cap, it's equivalent to price it, right? It makes no difference. And the legal cost of pricing a round right now is actually pretty cheap, right? You can have a price round finished in a pretty decent amount of pretty cheap price, right? And I think the second thing for us very important is governance. It's a corporate governance. So we like to have a formal board setup. We like to let entrepreneurs to start formally thinking about how the board looks like, how they manage board meetings, how they just do the general corporate governance, right? So I feel like without pricing the round, typically the corporate governance is a little bit lacking for startup, right? It will be 2 founders or 3 founders. They are on the board. There's no independent board. There's no investor board member. It could be a mess for quite a bit of the time, right? So we often like to price it round anyway, given it's a reasonable term, right? We don't want to screw up. We don't want to screw the entrepreneurs and give them really bad terms and stuff. But I think having a corporate governance structure on pre-seed round is actually helpful for the company. And we can laugh to the board after seed round or after Series A round. It doesn't really matter. That can be flexible. But I think having the corporate governance structure is helpful for the company at pre-seed. So I would say we're a little bit different in that sense. In fact, I think we priced all our pre-seed rounds so far.
Oh wow, I actually haven't heard that a lot. That is interesting.
Yeah.
Anyone else have a different way of looking at it? In terms of pricing pre-seed rounds?
It's just a way for investors to protect their investment.
Yeah.
It's a way for them to just have more protection. So it just depends on how the negotiations go. If you have enough leverage, then maybe you don't need to price the round.
But I don't know that it really is a disadvantage. The reason why it doesn't get priced is that it just costs, in the past it's cost legally.
Yeah.
So,
timing, right? Closing time, right? Sometimes you want to close fast.
Yeah.
Right?
So you could do really fast with it. Yeah. So,
yeah.
A lot of times, that drives it.
Yeah.
But I would say that Ping did bring up a point about governance, et cetera. I think we're a little bit unconventional in that we really we're very founder friendly, and we want to make sure that the company is successful. And so some VCs will really push for lots of investor representation on the board. But especially early on, especially in the seed round, we like to see industry experts on your board. We want you to be successful. And it's less important for us to have a huge, things get redone at Series A anyway.
Yeah.
So just think about who's on the board. You want to make sure that they're helpful to you. Also think about who you're taking investment from. It does bring up a point of if you think, oh, safes, I can just raise tons of money, 10,000 here, 10,000 here, there.
Yeah.
And if you end up with 30 angel investors, it becomes very challenging later.
Yeah, and I think the problem with safe and convertible notes, you're going to pay the legal price later on, right? So it's oftentimes it's going to be a lot of investors, you have to convert it to next round with, discount and cap, all that different stuff, right? So you have to pay the price anyway. So for us, like, to pay it a little bit earlier, right? So, but obviously, I think makes difference is actually not that significant. It's just our preference, but I think both ways are fine.
Okay, cool. This is an interesting question from Ed. In the deep tech sector, do you value IP development such as patents differently than trade secrets? Anyone want to take that one? Anyone dealt with that before where it's, not necessarily a patent, but it's a trade secret? Is that something that, would you value the deal differently, I think is the question?
Yeah, I mean, for us, just on our portfolio, we have, decent amount of company that are value trading secret more than IP. And that's very typical for software, for example, right? You can't really, do a meaningful IP on software, for example, right? Some of the core algorithm has to be trading secret, or, I would say it still goes back to our response, it's the team, right? It's not the IP, not the particular IP paper or whatever, but it's really the team behind the brain, right? Behind the idea, right? So I would say for us, there's no significant difference in terms of whether you have IP or trading secret. It's really the team, like who developed the idea, right? Who's in charge of execution. So
okay.
I would ask if do you really mean trade secret, or do you mean know-how? Because I think that know-how is your secret like sauce on top of patents and other IP that you might have that you uniquely, like Ari was saying earlier, like you uniquely can bring this know-how to the table. Trade secret is a bit like you have to take it pretty seriously, and I'm not an expert. I don't want to wade too far into this because I don't consider myself an expert, but I mean, that's like the Coke formula, et cetera. You really need to have certain protections in place to make sure that you it truly is kept a trade secret. And I would ask, like, why do you want to keep it a trade secret as opposed to being able to build on it? And usually, well, there are reasons, but I would just say that you may be talking about know-how, and know-how is incredibly important.
Yeah, I think oftentimes what we see on trading secrets only happens in formulation, and also the formulation for reagent companies is very common. And also for software development, sometimes have trading secret, but it's back to these points, very rare that you actually have a trading secret, because you are not a big corporate. You are not Nike that has, whatever, the big corporate that actually have a trading secret. Maybe it's a little bit of formulation here and there, but it's not going to be a real trading secret, to be honest.
Yeah, that's a good point too. So next question from Jared. Thank you for being here. What is the timing you like to come in on with an SBIR project? Near when it first gets the award after phase one? They're particularly interested in for biotech vertical. So maybe Ari, you could, and everyone can answer, but I know Ari, you also specialize in that vertical. So
yeah, I mean, I guess I would say the phase of SBIR is not that important. It's more about the technical progress that the team is making. It's kind of a case-by-case basis. Maybe phase one is just getting you a bunch of preclinical data, and phase two is helping you with translation or something. So it just depends. I mean, I would almost just take the label of the SBIR out of it and just more think about your progress as a company and your progress towards your goal. Those things are much more important than necessarily what phase of an SBIR you're in.
Agreed.
You want to add to that, Z?
Agreed.
There you go. All right. So Gustavo is asking, what's the typical equity path for founders if they get VC? How does it look year after year? What happens if founders leave or are asked to leave the company early because it's not a fit? So I guess that's kind of that could be a million answers to that. But if anyone wants to kind of take just a general stab at that, I think the main question is, I mean, we see this a lot too, where especially first-time founders, they basically don't put protection in. They'll do a handshake deal or just a deal with their co-founders that's not, they're not on any kind of vesting schedule, even if they're founders. And so if a founder, let's say there's 4 founders, one leaves and they've got a handshake deal, that can actually be a problem. So I think if you guys want to kind of, obviously when they got to the VC stage, you would not have that, that would not be the situation, but we see a lot of that pre-VC ready startups. So I guess equity path for founders if they get VC? I guess Gustavo is asking for ownership, typical ownership percentages, which again, I don't know how we really answer. It's case by case, but anyone want to take a stab at that one?
Yeah, I would say for the first part, in terms of the, if founder leaves or invited to leave, for most VCs, if it's, again, if it's price round, meaning we have all the proper documents, founder will start reinvesting at the time of investing, It depends on what's the schedule, but we typically have the founder reinvesting schedule on it. So the founder will start basically reinvesting their shares, their founder shares at the time we invest. So obviously, at the time the founder has to leave, there will be different negotiations, all that stuff, right? So it's going to be a very complicated structure, but that's one thing. In terms of the typical equity pass, generally, in venture, you basically go with a larger round each round. So, right, so it depends on, how much money you need, but it's really dilution wise. First round will typically take anywhere from 10 to 30%, depends on the range. And then later rounds, once you go to growth round, and once you go to a larger pre-IPO round, the dilution takes less and less dilution for each round, right? So the larger the round is, in fact, the less dilution you take, right? So yeah, that's the data points I have.
Okay, great. Mia, hey Mia. Mia asks, this is a good question. We're getting this a lot, actually. She wants to know how much longer the due diligence excuse me, process is at each of your funds during the COVID-19 period. Is it longer in comparison with pre-COVID times? So basically what we are seeing this with a number of our startups where due diligence is taking potentially a lot longer than it maybe previously would have. And maybe that's, if you can, any of you can comment on that, if that's a issue for your funds.
Don't have to find parking, don't have to fit the commute to my list. Like, it's great. I don't think it's any longer,
Okay.
to be honest.
Okay, good point.
Yeah, I mean, I guess I would try to read into that and understand, why is it taking longer? Is that just an excuse? Because just looking at sort of the data and, the flow of doing work in the COVID world, there isn't really any particular reason why it should go slower. I don't think, we're still able to have our virtual partner meetings and, we talk to our LPs and et cetera, et cetera. So I don't think diligence should necessarily take longer. I would be curious to see if there's something else going on there.
Okay.
Yeah, I agree. Agree with that.
Okay. Betsy asks, how much funding interest is there by VCs in the early stage wearable biosensor startups to provide metrics to telemedicine? So I guess a wearables biosensor question in telemedicine. Does anyone invest in that space? Does anybody's team invest in that space and that kind of, I guess, med device?
Yeah.
Okay.
But I'm not sure I understand the question.
I'm not sure. I think Betsy's just wondering if that's an area that has investor interest. So she's saying early stage wearable biosensor startups that provide metrics to telemedicine. So combining, I guess probably a hardware software play. I don't know, Betsy, so I can't really.
So I would say that, so we have invested in telemedicine. It doesn't tend to be wearables as much as, for example, Illuna is a spirometer that you can manage your asthma and anticipate using machine learning, anticipate when you need drugs so that you can use much less, for example. Doing great right now, obviously, sadly. Another company, LumenDX, which is doing analysis of skin conditions, but they're not wearables. We tend to shy away from the consumer market where you would just buy a device and then use it to manage health as much as, like your personal, consumer stuff, and much more targeted at people, sort of getting into the reimbursement process and working with the doctor's offices, that type of thing. So that tends to be more of where we look. Hardware is hard. So we also want to make sure that you know how to bring a device to it, or at least you can try to connect you with the right resources. But that's usually a little bit of a extra hurdle for us.
Okay. Ed, actually, before we get to Ed's question, I have a quick question that comes up a lot, especially for the startups that we're trying to help bring out of the research labs. And that is the solo founder question. So I think the founders get tired of hearing it from me. So I'd just maybe get some thoughts from the investor panel on how your team looks at and thinks about solo founders who have no other co-founders in terms of investability from a VC perspective.
Well, I can say from a personal experience perspective, having been a serial entrepreneur, is being a solo entrepreneur is incredibly difficult. And it makes, having been through all the different, permutations of that, I'm not going to be enthusiastic about investing in a solo entrepreneur. I don't think that unless you're, I want to see a well-rounded team. You don't have to have all the pieces in place. You need to know what's missing. But I will say, I remember when I was starting my first company, and this was decades ago, but there was a study that was done that showed that your likelihood of success increases with each additional partner, founder, co-founder, up to 5. I think beyond that, there's too many cooks in the kitchen. But man, I remember there were times when I was down in the dumps and thought that I was ready to throw in the towel. And then my other 2 partners were like, come on, we got to go. Like, you just have to have the other people to keep it, if not for no other reason, to keep your head up high and your optimism going.
Definitely. Ari and Ari, do you guys, do you invest in solo founders?
Yeah, I mean, we're not dogmatically opposed to it. And I would say that being a solo founder is better than having a bad co-founder.
That's a good point.
But no, I mean, Z is absolutely right in terms of kind of what the numbers show and the broad experience with solo founders. And I think, I don't know who said it, but someone said this once, that if you can't convince someone else to sort of take this journey with you, then how are you going to convince investors, customers, et cetera, et cetera? So, if it was a solo founder who had a great sort of group of advisors around them, it's got to be more than one person involved in some form or fashion. And maybe a conscious awareness that they need to expand the team with this sort of seed round or whatever it is. I think that's tolerable, but it's definitely a tougher slog if you have just yourself to rely on.
I'll also say that there is a step change in your attitude when you have another partner, and that when you're a solo entrepreneur, you're always just you think of everything, every problem, every challenge in terms of what you personally can solve. The moment you bring at least one other person onto the team, all of a sudden you think differently, where you're like, oh, who can solve this problem? It's not just this small view of what I can do. So I think it's really important.
Yipeng, any thoughts on solo founders? So funding solo founder startups at the VC level?
Yeah, I mean, we're not against it, but honestly, we haven't actually founded any solo founder team. So I would say, in principle, we're open to do it, but I think in reality, there's different question marks from it, right? So I think number one is, from Ari's point, it's the ability of finding another people that you can trust or support your vision as well, right? So, if you can't really find anybody to support your vision, it's hard for convincing investors to support you in that case, right? So I would say, and also just mentally, I can't believe, startup is really hard. I just don't know how you can mentally run a company with your, only one person as a founding team, right? It's mentally really hard, I feel like. So, yeah.
Yeah, that's good. That's a good point.
Yeah, but Ari's right. Don't bring
bad co-founders. Right?
don't bring on the real estate mogul from the parking lot at the football game. Yeah, I agree with that, definitely. So Ed asks, in our pandemic era, are you and other VCs accepting pre-recorded pitches in lieu of in-person pitches? Or maybe instead of pre-recorded, I guess we would say online, because I don't know about pre-recorded, but so I guess the question is, I assume you have to be flexible and you are taking pitches via Zoom, I would assume, or else you're not going to be getting a lot of pitches, right? So, but anyway, if anyone wants to weigh in on any kind of maybe some new ways you're looking at deals based on the pandemic, maybe that's a better way to frame it.
Yeah, no pre-recording deals, like no pre-recorded videos. Just do not send it. That's just bad, to be honest. It's bad practice.
Okay.
Zoom pitch is good. I mean, we can do Zoom pitch a lot of stuff, but pre-recorded is really bad.
Okay.
At least my experience, really bad.
I think with Yipeng's point earlier, it's like your goal with the pitch is to try to get the next meeting. So I think your goal with the initial email or whatever contact is, first of all, for them to open the email. The next one is for them to either open the attachment or click on, you know, but then, so that the pitch deck is what, you know, you look at quickly to just get a sense, is this even in my wheelhouse? And I get so many pitches sometimes that are just so off base from what I would invest in, and that's whatever. It's just a waste of my time. It's a waste of your time. But really, like, just make it super easy for me to know whether it's even in my wheelhouse. A video does not help you do that. I'm not going to sit through a 10-minute, 15-minute video. I'm going to be able to flip through some slides.
Yeah, that's great. That's a great point. Brad asks, what are some of the covenants that we should expect from a VC investor? Are these negotiable? Anyone want to take that? I guess they're talking about the term sheet.
Yeah, I mean, everything's negotiable, right? Everything on the literally everything on term sheet are negotiable.
Yeah.
So yeah, I mean, it's price, it's a valuation, and, you know, investor protection clause, I would say, anti-dilution, board members, all the other standard thing. Preferred shares is very important for investors. So liquidation preference is probably the #1 thing that often negotiated during the term sheet negotiation. So I would say liquidation preference is probably the #1 thing that's being negotiated. Although I would say in the West Coast, it's very standardized nowadays. I haven't seen a lot of creating on liquidation preference clause, at least for pre-seed and seed. So yeah.
Yeah, I think anyone else want to weigh in on that? I would just say that, you know, there's so many amazing resources now. There's and anyone who doesn't know them can get in touch with me and I'll send them to you. But there are some amazing, obviously tons of VCs are on Medium, they're blogging, they're on Twitter. They've written some really good books from top investors about, you know, how to look at deals. Brad Feld has an amazing one. There's another one from an Andreessen Horowitz. What's this guy's name? Scott. I've got it. It's called The Secrets of Sand Hill Road. There's another really good one, I think. So, you know, there's great stuff out there, but also, you know, you really want to, at the point you're raising VC, you also want to have a business attorney that you trust and that has done deals before, so that they can also take a look at the term sheet. And, you know, there may be something that you're, as a founder or a founding team, you're not thinking of or whatever. And so I would recommend having an attorney you trust look at the term sheet. And then, as Yipeng said, everything is negotiable. So you just, you know, it's going to depend probably on how much deal heat you have in terms of how negotiable things are. But, you know, if you get multiple term sheets, then things are more negotiable than if you don't. So anyone, Ari or Z, you want to add anything to that?
Well, I might say too that there's a lot of, so first of all, yes, Brad Feld's book is great. And he also has this class a couple times a year that you can sign up for. And it's, I think it's like 6 or 7 or 8 evening, you know, it's like weeks of lessons. And so if you're kind of in the process of doing it, like, take that class, it's helpful, or just read the book. But I also think that it's worth setting expectations around competitive deals, especially in the academic space. I find that more often than not, we find that there might be one firm that's interested in doing a lot of the due diligence and leads, and then maybe brings on some co-investors, rather than having it be this really hot, the latest hot $100 million, like right out the gate, you know, clubhouse kind of deal. You don't see that as much with academic startups. I don't know if Ari and Yipeng have different perspectives on that.
Yeah, but I mean, I think you will have potentially competing term sheet, but never the clubhouse type of deals, right? Where you have like 6 Sand Hill Road VC will write your term sheet at $100 million valuation. That's almost impossible, to be honest. So,
yeah,
you know, you might have like 2 VCs bidding like at a similar range. So I would say that's very common, but I don't think you will have the traditional Sand Hill Road competition in that sense.
Yeah,
so it's very hard.
That's a great point for deep tech, right? Yeah, that's a great.
Yeah, and I just like a warning. You know, there was an entrepreneur that we were talking to that was she was like, okay, we're almost like a real estate agent. She was like, okay, we're going to be getting all the term sheets in 3 weeks. So that's, so she was setting things up where she wanted to try to get that bid. And we're like, okay, great. Well, we're not going to lead this deal, but you let us know when you have a lead. And sure enough, nothing came in and it just kind of
Yeah.
flat. So just set the expectations right. You're happy, like just be happy if you get one decent term sheet. That's awesome.
Yeah,
And
no, that's a good
don't
point.
ever say like we're expecting term sheet for other investors, because that's just
Right.
very
Well, and also you got, and also also the three of you, you're investing so early that like you said, that kind of clubhouse kind of, or whatever, the hot deal, that's typically not, most of the deep tech
Right.
startups aren't coming out of Y Combinator in the Bay Area, et cetera. So it's like, I agree, it's not kind of the same thing. So, but I do think that, I do think that the founders still should educate themselves with any of the free tools we mentioned, or a $25 book from Amazon that, probably certainly worth it when you're talking about the future of your startup.
Yeah.
Amit asks, I've invested $200K, friends and family and self, and my 2-year, 15-hour-a-day time in my startup. What round should I raise? Angel, VC? It looks like I'm ready for VC. Anyone want to take that one?
The first thing I'll say is, unfortunately, for better or worse, the round you raise next is only looking forward. It's a little maybe crass or crude to say, but we don't care too much about how much time you invested. The proof is in the pudding, right? So the calculus around how much you should raise and who you should raise from is about the sort of future value of your company, as opposed to how much you've already kind of invested in terms of your time. Now, granted, that time I'm sure went to good use and, generated a lot of data and built something really compelling. That's the most important thing, though, as opposed to just sort of thinking about it in the framework of that kind of sunk cost fallacy. So I think the key thing is just to think about, what does the path for your company look going forward? How valuable could your company be? What's the market you're going into, yada, yada. That's really what dictates how much you should raise and who you should be raising from.
Yeah, I mean, given all the risks that you've taken to do it, let's hope that your company is worth way more than the hours that you put, the two years that you've put into it. That's the whole goal as a startup, is you take lots of risks and you just get a lot of leverage out of your expertise. But yeah, Ari, you said it nicely. It's really about the future.
Yeah, that was a great answer.
Yeah.
We're getting a lot of questions about, do you invest in this or that vertical? I would just say, instead of having, answering those, just please go to the websites and just check it out for yourselves. I mean, you can see if this panel is interested in your vertical. Hold on one sec. We had one from, just a sec. Oh, Matthew. Hey, Matt. Let's see. Do you have any recommendations on how to prove a strong freedom to operate? Looking for official current patent attorney reviews, or just founders showing that they've done deep competition IP review? So I guess if I guess it's more of a question of how are you all assessing how strong their patent is or their IP is, if they're in a space that has other competitors, I guess, is kind of the question there.
Yeah.
Any thoughts on that?
Yeah, I think it's a very, very tricky question, to be honest. Again,
Yeah.
I'm not an attorney, I'm not an IP attorney, but I think freedom to operate is actually very tricky in the venture space, especially early stage.
Okay.
You only want to do it if you absolutely need it to do it. That's my thoughts. But obviously, I might not be right here because I'm just not an attorney. You want to have absolutely confidence you can get the freedom to operate before you start doing it and find an attorney to do it. Because otherwise, you might run into some trouble. So some fund will ask you to do it as a diligence item. Some fund will not require it. But oftentimes, I don't think funds will require you to do freedom to operate. But I don't know about other folks, but we don't really require freedom to operate as our diligence package. But I know some bigger funds will require to do it.
Okay.
Especially in the therapeutic space. But yeah.
Okay. Sophia asks, would love to hear more about telehealth platforms you're investing in. What solutions do you think are needed to transform telehealth and make it more mainstream after COVID with regards to reimbursement? I don't know if any of you are invested in telehealth, but if so, does anyone want to take that one?
Well, no doubt a lot of healthcare is going more to the home, and COVID has been the great accelerant. I wish I were the expert on our team to share meaningful thoughts, though. I'm not the best person to comment on it.
Okay. Yeah, I don't know. I don't think we have a lot. I don't know if this panel particularly is doing a lot of telehealth investing. It sounds like not. So
We are. It's just not. It's not me. I mean, I help with it. I've been sourcing a bunch of deals. So.
Okay, well then maybe, yeah, maybe they can, the
Yeah.
entrepreneur can check your website and see if there's another, person to reach out to.
No, and I could play point. But I think part of it is we want to make sure that you're adding, you're taking on a particular part of the market that actually is particularly challenged. We don't want to see a lot of competitors in the space. It's not really interesting to be just a one of many. And so we want to see some deep IP there. We want to see like a real pain point that's being solved by your technology. Want to see like what are the reimbursement codes that are going to enable you to get paid. Those are the things. I just don't consider myself the ultimate expert on this, but those are some of the things that you might want to look at.
Okay, great. Ed has a question that I'll just paraphrase. Basically, are you seeing, and because I think this cuts across a lot of different verticals, are you seeing a lot more pitches that are related to solving climate change in different verticals, just as a general question? So climate change that, is addressed by an ag tech solution or a clean tech solution or a biotech solution or, any future of food, all those different verticals. Are you seeing pitches that are, I guess, keen on the solving climate change as part of their pitch, or not so much?
We've been seeing increasing number of pitches that are doing more impact vision or impact angle, whether it's climate change or food or any other stuff. So, but we are not impact investors, so I can't comment on how to assess impact investing. For us, it's a business model that matters more than, we care about climate change and impact and all that stuff, but as an investment fund, I think we're not impact investing in that sense. But we do see a lot more companies that are having an impact angle. But I think for us, having the impact angle is always good, right? So, but proving you have you have a good business model overall, right? So.
Yeah, I think, we're seeing, because we see a lot of deals that come into us, and we are seeing a lot of climate focused solution stuff. But again, it has to, if you look at the number of investors out there in general, and if the B2B SaaS software startup, VCs are like this much, and the deep tech is a much smaller slice, and hardware investors much smaller slice of the overall VC investor group, then I think impact investing would even be smaller than that, because we have a number of startups that have tried to stay impact focused, and I have to say it's been a challenge to help them try to raise capital. Now again, who knows? You could get really lucky and get a term sheet right away, but in general, I just don't think there's many active impact investors as there are deep tech investors, and certainly not as many deep tech investors as there are software and SaaS investors in general.
This is the thing, the world runs on money. So you have to, I think the best way to make an impact is to figure out what is a business model that will get you there. Now for us, we don't invest in anything that we feel is going to have a negative impact. We actually do invest in things with positive impact. Some people would consider us an impact fund. However, 100% of our decision to make, so the impact is what gets our interest. And that's how, if you appeal to our heart, you get our interest. We get thousands of deals in the door. So if there's something that's going to really change the world, then you're going to get our attention. Once you got our attention, now you have to say, how are you going to make money? And we're not going to invest unless it's going to make money.
All right. Yeah, that's great. I think, so I guess all the other questions, they're basically all questions about, do you like this vertical or that vertical, or would you like to invest in I'm going to leave those for now. And let's just, let's wrap up with any final thoughts just for this group. Also, this will be out on YouTube eventually. So you'll have other founders watching this probably who are deep tech founders, and also, who are potential postdocs, grad students, undergrads, professors, working to bring their world-changing technology out of the labs and the research facilities around the country. So any just parting thoughts on just, deep tech startups in general, or any other words of wisdom for the founders from each of you?
Yeah, I can just quickly start. I mean, I'll say I'm a big fan of scientific founders. I'm a big fan of grad student dropouts, PhDs, postdocs, whatever you got. So I think I'd like to just give those people my support, and that, you know, doing a PhD a lot of times is actually, it's easier for you to learn the business stuff than it is for you to learn the science on the job. So, you know, if you're coming out of a lab and you have a really great idea and you feel compelled to start a company, you should feel confident that you can do that.
Great. Z, you want to?
I would, yeah, sure. I would say you're on a challenging journey. Ask yourself if you really want to do it. It's okay if you don't, but if you do, I'm behind you all the way. I would say stay confident and optimistic, yet humble. You can't do it all yourself. And really talk to a lot of people. Ask everyone's advice. Share your idea, you know, and listen. But then at the same time, don't take any one person's advice. Because it's ultimately you who knows your industry, your technology, et cetera. And that's your role as the entrepreneur to synthesize all that input. And don't say, oh, what would these experts do? No, what would you do? You're the entrepreneur. Listen and then make your own decisions.
Yeah, that's great advice. Yipeng, any final thoughts?
Yeah, I'll say, you know, two things. Number one, I mean, first, everybody at the end already said, I totally agree. I think, you know, one thing is, you know, it's definitely a hard journey. So definitely have open-minded, you know, even if it fails, it's not your fault, right? I mean, statistics shows 99% of people fail, right? So even the startup you have working on didn't succeed first time, you might have a second or third chance as well, right? So always have open-minded for, you know, for the failures at some level. And I would say second thing is, since we are in Southern California SBIR panel, I strongly recommend people stay in Southern California and grow our ecosystem.
Yes.
Do not move to the Bay Area. Do not move to, you know, Bay Area or, you know, Boston or whatever other locations. I think we have a tremendous amount of community here we are building right now. Like, you know, we have investors, we have universities, research labs, and government funding agents. So seems like we have a very good ecosystem already. Start building up. Just do not move to Bay Area. So yeah, I mean, stay here and let's grow this ecosystem together.
Yeah, that's actually a great way to end, because, you know, all of us are working to build a strong Southern California tech ecosystem down here, and you don't need to move to the Bay. You don't need to move to the Bay Area anymore necessarily. You don't need to move to New York or Boston or wherever the hot place was 10 or 20 years ago. Of course, you know, if you're have great connections there and it makes sense. I mean, of course, we're founder first, so it's whatever's best for your startup. We're not going to recommend that, you know, a space tech startup doesn't move to LA to be closer to SpaceX if that's, you know, where they're going to want to be. But in any case, I think that's great. Let's definitely try to keep some of the talent here. Let's keep some of the startups here. Let's bring some high paying jobs to the region, especially our inland California region has been extremely hard hit by this pandemic. Even before, you know, we need to have more high paying jobs and more opportunity for, especially we're graduating a lot of talent. I think we probably graduate more talent out of in terms of STEM talent in Southern California than almost any other region of the country. So it'd be great to keep that talent home. So that's a great way to end it. Martin and Misty, we'll turn over to you in a sec, but I just want to thank the panelists. Having you all here was absolutely great. And I know that the founders who asked their questions will appreciate hearing it from you know, the answers from investors who are writing checks as opposed to me and our other mentor team. So really appreciate you guys joining and also all you're doing for the Southern California ecosystem. So we'll turn it back over to you, Misty and Martin, and thanks everybody for joining.
Thank you.